Hello, this is a 2023 version of our 6 indicator system review and what's happened since our first such video about a year ago. This one we're titling, When Does the Recession Arrive? So we have our 6 indicators from advanced projections that we've been using for a number of years now, and we have created an original video in April of 2022 which explained each of these indicators in detail and what they did. So if you haven't seen that, or if you've forgotten what these indicators tell us, you can use the link provided in the video, and it will lead you to that presentation from April 2022. And I suggest you look at that one first before you go through the remainder of this one. And if you do remember that, or if you just care for the current explanation, here we go. First of all, there's a misconception that no one can predict a recession ahead of the fact. What is true, and we can show it here demonstrably, our 6 proven indicators have worked perfectly over 7 recessions since 1972. The first 6 were back tested when we came up with the system, and then they worked very well in the recession that was cooking just before COVID hit. And then, of course, the COVID recession sort of, pushed everything over a cliff. But even before COVID was spoken of, we were already headed into a recession. So our 6 indicators we've looked at, since the beginning of 1972 are a leading economic indicator, a money supply indicator, Federal Reserve indicator, yield curve indicator, stock index indicator, and precious metals indicator. And over here to the right, this is what these indicators have done since we came out of the COVID recession. Had a little bit of peace and quiet until inflation took hold and the Fed program to quell inflation began to take place. And our indicators have gone from high warning levels down to the 25% or so level, and we're all the way back up to currently 90+% probability of a recession happening. Now, this is a classic business cycle behavior. We had an extremely strong pre-recession setup. We issued an extreme equity market risk warning back in February of last year, and that came, at a point where the S&P 500 was down a couple percent. Subsequent to that, it went down a total of 25% and has come back about halfway from that bottom. Now, we also made a series of projections last year, 4 of them, and they all came true. We're going to go over that here a little later in the presentation, but we're verifying that what we said was correct, and now we have a new set of projections for the remainder of 2023 and the beginning of 2024. So let's look at the 6 indicators. This is what our leading indicator looked like at last April. It was still green. Since then, you can see that, we had a quick bump in activity, and then it started to crash. And basically, it is deep into red territory at this point. The leading indicator index is based on information provided by the Conference Board and by the Federal Reserve as well. The money supply indicator. Last year, we had this big bump in COVID response, COVID rescue, which jacked up the money supply to extreme levels, but the Fed started dialing back that growth and now is in the process of actually contracting the money supply. They had started doing that back in April of last year. Look at what's been going on since then. All right. This indicator is also deep into red territory. Federal Reserve has its own set of recession indicators. Last year, it was a slight warning because the Financial System Stability Index had been increasing as a consequence of their first couple of rate bumps. But this is what it's been doing since then. Now, you'll notice a slight difference in these two charts because this one is based on a new set of data which we incorporated into the Fed indicator, but it does not change the overarching results. And if you look here where we were last year, that's this point. And since then, we've been banging around between yellow and red, and we're currently in a red state. The yield curve indicator. Last year, the yield curve had not been much affected by what the Fed was doing in April because we've only had two bumps to interest rates. So the yield curve was still looking healthy. That was green. A year later, okay, here's where we pick up, and the yield curve approached inversion and finally did invert fully in October of 2022, and that inversion has been accelerating downward. It's still going down, and we'll look at that, what the Fed does with that information here in a couple of slides. Now, the stock market index, that's our noisiest indicator. The markets have been all over the place. Equities markets and the investors there still don't believe what's coming. So they've been pushing, some relatively high volatility up off the bottoms that were set last October. And we're back about a halfway point in recovery from the highs set at the end of 2021. This is about all we're going to get out of the markets. So at this point, the stock indices basically have been causing our indicator to dither around between red and yellow territory, and we expect that to continue. Finally, our precious metals index. This looks at the ratio between the prices of gold and rhodium. And we went way back in 2018, we went from a long period of green to yellow. Rhodium became very, very expensive and has stayed that way. In terms of its price relative to gold, we have a specific ratio in mind. It's around the value of 3. So rhodium has been way more than 3 times the price of gold up until very recently. Now, rhodium has fallen back about 60% from its recent highs. Gold has picked up a little bit, still not doing anything, fantastic in terms of a price breakout. It's around 2,000 an ounce. Rhodium has bounced off of 6,000 an ounce back up to a little over 7,000 right now. But that keeps our precious metals indicator red, just like it was last year. It's currently red here in April. Okay, so here's our refreshment of what we predicted back in 2022, or a review of that. This is what happened given our exact projections. Now, if you've just recently reviewed that 2022 video, you'll see these 4 projections made in there. So that at that time, we said the latest large dips in unemployment due to significant workforce and employment expansions went down to 3.6%, and we're still falling. Our target was expressed at that time as 3.3 to 3.5% as a bottom. What actually happened? Unemployment dipped to 3.4%, right smack in the middle of this range, and it currently stands at 3.5% here in April of 2023. The second projection we made was that ultra low unemployment gives the Federal Reserve a free hand to focus solely on their second mandate, which is stable pricing. They have begun raising interest rates and reduced the money supply to bring inflation down, but may have to act much more aggressively soon. Well, that's what the Fed thought too, that they would be able to sort of tiptoe into this situation, and that showed up in their dot plots, the quarterly dot plots from December of 2021 and March of 22, June of 22. But every time they create a new dot plot, they identify that they have a longer process ahead of them and a more aggressive process ahead of them. So what happened since we made this statement? The Fed aggressively moved their Fed funds rate from 0 to today's 4.75% in exactly 1 year, and we continue to expect further rate increases. Okay, so now long-term inflation concerns would not yet be reflected in the prices of precious metals at that time. This was a year ago. And these normally accelerate upwards rapidly if smart money is concerned about prospects of long-term inflation. Well, what has happened? Gold and silver have moved up slightly, while rhodium, an industrial precious metal, as I just mentioned a few minutes ago, has fallen by over 60%. Rhodium is typically not an inflation hedge because the supply of it is very limited. Gold and silver are ubiquitous, and people like to hang on to that stuff in their safe deposit boxes or in whatever safe place they want to keep their inflation hedge. Okay, last year portions of the yield curve have already inverted temporarily, such as the 3-year versus 30-year yields back on the 5th of April last year, but not the specific comparison of our highly accurate 3-month versus 10-year comparison. And that is the one that is most telling. That's the one that the Fed uses in their calculation of recession potential. So what did happen between April of last year and the current time? This key yield curve inversion, the 3-month versus 10-year, inverted in October of last year and has widened considerably to levels not seen since the last great inflation fight in 1981. So this is, a simple verification of the success of our indicators. Low unemployment with a recession probability of 90% plus means a recession is ahead somewhere in the 6 to 18-month time window. This is how our recession indicators work. You see, when we get to 90%, a recession does show up, and that happens in every case in the last 7 recessions. Our probability right now is 90% plus and has been there since October of last year. So that means a recession is likely to begin soon. So what should we expect in 2023? Well, who agrees with our recession forecasts here in April of 2023? We have the Conference Board, which is a set of economic experts that looks at global economies and very strongly at the US economy. This is a long-standing organization with historical expertise in leading, coincident, and lagging economic indicators. And this is their chart from this most recent publication from them, most recent report. And they show you, first of all, the historical accuracy of their recession projections. And here's where we're at right now. Again, we're well into recession signal territory for them, and they say it's highly probable. Here's the Federal Reserve recession projection mechanism, or they have an algorithm which uses the rate of change of the 10-year versus 3-month yield spreads. And literally every time that their probability goes above 40%, you can expect a recession. Now, sometimes that probability occurs after the recession or within the recession. The point is, it is inevitable that above this level of 40%, that a recession is going to occur. So we're there. We may be in it already. Well, we don't quite think so. The numbers that just came out said the first quarter of 2023 grew at a very tepid 1.1%. That may be revised downwards yet, but we're expecting here that we will see something happen in the next 2 quarters. So here's what we expect going forward from April of 2023. So the latest large dips in unemployment are over. Our target bottom was met at 3.4%, and it's likely to start moving up from here. It may have a flat spot at the bottom here in the mid 3s yet, but eventually it's going to start going up. So expect some small increases in unemployment to begin within 3 months. A recession, a widespread GDP contraction, begins in the second quarter or third quarter of this year. With unemployment still below 4%, the Federal Reserve has a free hand to focus solely on their second mandate, stable pricing. They'll continue to slowly raise interest rates and reduce the money supply to bring sticky inflation down. The terminal rate, which is where we expect them to actually stop raising rates, is going to be when their Fed funds rate lands somewhere between 5.5 and 6%. If inflation proves to be even more intransigent, it could go even higher than that. Earnings for equities will suffer throughout this entire year, and the market will decline to test the lows set last October and then break below to establish new lows. And where the actual bottom is, we can't yet tell. So the exact history of the bull market that began after the early 2020 COVID correction was based on, great euphoria. We had a lot of money dumped into the economy. The Federal Reserve and the Treasury put money out there to keep the economy from falling apart. And it was sort of like giving it a huge shot of adrenaline. And we came out strong, but with very high liquidity and some supply chain constraints. We had too much money chasing too few goods, and we ended up with inflation that pushed as high as 9%. Now we're trying to get out of that. So there were many reasons to be euphoric in late 2021, including a visible path to the eventual end of the pandemic, but that was just a warning that the party must eventually end. No one knows this better than investors who have lived through 4 to 7 major market pullbacks. You can expect this to be another big pullback as the super bubble in equities collapses. So thanks for listening. Please consider giving this video a thumbs up and subscribing to our AP Newsroom YouTube channel. We've had a lot of new subscribers show up in the last few months. You can get limited time free access to our full member reports and member report history going all the way back to our inception 10 years ago. This will show you that, we don't pull any punches as far as trying to hide bad projections or anything like that. It's all out there right in front of you, and you will see that, we have been extremely accurate in what we're doing in terms of trying to guide investors, especially passive investors, from staying out of trouble when things are going to start looking bad for the economy and the equities markets. Join our free economy monitoring group on Facebook with the link in the description below. And please leave us some comments with your thoughts and questions along with this video. Thanks again. This is Rich Vessel, founder of Advanced Projections from April 2023.